Operating leverage is one of the most important concepts in this chapter, and it's not given a whole lot of attention in some of the books, but it's really an important concept, and it really is a discussion of the relative extent to which fixed costs make up a company's cost structure. So a company can choose its mix to a certain extent. Some manufacturing processes may be more labor intensive than others, but you can choose to perhaps mechanize, use robotics, and then that would become more of a fixed cost type of investment. And so if we look at Company A and Company B, and we see their total costs in the little egg-shaped oval, a Company A has much lower ratio of variable cost to fixed cost. So they have more fixed costs. They would be considered to have higher operating leverage. Company B has smaller fixed costs and larger variable costs, so they would be a lower leverage firm. And that's going to have implications for the effects that changes in sales volume will have on the company. So the degree of operating leverage, that's the term your book uses, it measures the effect of changes in sales, right, the changes in revenue on net income. And companies with higher operating leverage, they're going to have more of a dramatic change in net income when sales fluctuate. And the computation is the contribution margin divided by the pre-tax or net income number. And so let's look at a tale of two companies. We're going to look at Oldies, which is a company that's labor intensive. They pay for their labor, so they have high variable costs and relatively low fixed costs. In the same industry, we have Newbies, and they've decided to mechanize, right, to automate their production process, so they don't have a lot of people, but they have a lot of machines doing the work. And so they've got low variable cost, but a high fixed cost. You can think of that as a straight line depreciation year after year after year as they depreciate this equipment. So let's compare the results of the two companies in the contribution margin format income statement. So Oldies has sales of $1,000. Their variable costs are high because they're the labor-intensive company, so $700 of variable costs. That gives them a contribution margin of $300, less a small amount of fixed cost, and they've got pre-tax income of $200. Newbies, on the other hand, also has $1,000 of sales, but they don't have a lot of variable cost, maybe a supervisor or two or a couple of laborers, but $200 of variable cost, and so their contribution margin is $800, and their fixed costs, on the other hand, are very high, $600, and that gives them pre-tax income also of $200. So both start with the same amount of sales, both have the same pre-tax income, but their distribution of cost, right, their cost structure is different. One is very variable cost intensive, the other is very fixed cost intensive. So what if both of them, the whole industry, experiences a dramatic decrease in sales? So let's assume a 20% decrease in sale. Will both companies experience the same amount of lower profit or the same proportionate change in profit? A lot of people might think the answer would be yes. I think we need to look at it. So operating leverage can be used to help us predict that outcome, and now let's see how. So let's have revised versions of the contribution margin format income statement. So after the sales percentage, Oldies wouldn't have $1,000 of sales anymore because they decreased by 20%. So 20% of the 1,000 is a $200 increase in sales. So sales are now only $800. If they sell fewer units, then they're going to have lower variable costs. So $700 was their variable cost before. And now that went down by 20%, so a decrease of $140. So their new variable cost is lower. It's down to $560, and they've got a contribution margin of $240. Their fixed costs don't change, right? Just because you sell less doesn't mean your fixed costs get to go down. They stay the same because that's why they're fixed. And so their pre-tax income drops to $140. So it went from $200 down to $140. Let's look at Newbies' situation. So same format of the income statement, and Newbies also sells 20% less, so their revenues, their sales are $800. Their variable costs were only $200 to start with, so they drop by 20%, or $40, so their new variable cost is $160, and their contribution margin now is $640. Their fixed costs are 600, and they stay at 600 because, again, that's why they're fixed. They don't change the level of output, and so their profit drops fairly dramatically, all the way down to $40. Operating leverage, had we computed that up front, it could have helped us predict this outcome without creating the new contribution margin format income statements. So just a reminder, the degree of operating leverage is based on the contribution margin divided by the pre-tax income. So for Oldies, they had contribution margin originally of $300 and income of pre-tax income of $200, and that gives them a operating leverage measure of 1.5. Newbies, which had a lot more fixed cost, and I said high fixed cost means higher operating leverage, theirs is 4. They had contribution margin of 800 before, divided by their pre-tax income of 200, so their operating leverage was 4. And you can think of the operating leverage as a multiple. So if there's a 20% decrease in sales, we multiply the percentage decrease in sales by the operating leverage to give us a predicted change in net income. So a 20% decrease in sales gets multiplied by the 1.5 operating leverage for Oldies, and that says Oldies should expect to see their income drop by 30%. So even though sales only drop by 20, their net income is going to drop by 30. And that's because you aren't eliminating any of your fixed costs, and you can't eliminate any of your fixed costs. And for newbies, the situation is even more dire. A 20% decrease in sales will have an 80% decrease in income. So a multiplied effect. And so when companies are making sort of strategic decisions, they've got to think about sort of the risk and the reward. It's really nice to automate, and it can save you money, but if there's a dramatic, even just a 20%, and that's dramatic, a decrease in sales, it can have an 80% decrease in your bottom line. So firms need to be aware of that. And we're going to talk a little bit more about this in class and talk about firms in different industries and why we see some of the dramatic changes in profitability, or when there is a shock to their industry, how some firms cannot withstand that and end up having to close up shop.